Everybody, welcome. Let's start with the market data. Overall markets are basically flat. Dow Jones flat, Nasdaq down 0.3%, S&P 500 flat, Russell 2000 up 0.6%. Interesting that Russell small cap stocks are finally showing some sign of life. Meta is down 3%, Eli Lilly down 8%, I believe, based on guidance. Nvidia down 2%. Utilities are generally up, and financials are up as well. 10-year Treasury yield is at 4.81, and 30-year is above 5%. Interesting. Let's see. 10-year is at 4.81. Oh yeah, this is the highest it's been in the last 5 days. I think it's the highest it's been in a while. Um, Highest 10-year Treasury yield since October of 2023. Interesting. Also, that's the time when the stock market had bottomed. Sorry, that was October 2022, I think. So, despite today's inflation data, producer price index came in lower than expected, especially the core figure came in flat versus expected 0.2 and prior 0.2. The yields are surging higher. Interesting. Wall Street flips as focus shifts to earnings, consumer inflation data. Tomorrow we're going to get CPI data. Um, I don't particularly have a reason why they should come higher or lower than expected. So I don't have a view on tomorrow's CPI data. But generally speaking, I think services inflation is continuing to be a problem for the Fed. And especially if you dig deeper into this PPI data today, you'll see that airline fares surged higher, airline fare prices surged higher. Let me see if we're having an issue on the YouTube right now. Test, 1, 2. Give me 1 second. Let me just fix YouTube real quick. Test, 1, 2, 3. Okay, YouTube should be better now. All right. Let's read. So PCE was revised upward again after today's data. So despite the headlines that inflation data was lower than expected, PC numbers were revised upward because only some of the PPI data feeds into PCE, and those data points came in higher than expected. So the Fed's preferred measure, PCE, was revised higher. So that's a problem. So the initial reaction to the data was just wrong by the markets. That's why we're seeing yields back up again, especially the long end of the curve, which for mortgage rates and all loan rates, that's what matters. Crude oil prices are at $78 per barrel. They're up from $65, $66 just a month ago. So that's a significant increase in just a matter of months. But year over year, they're pretty flat. So I don't think it's going to be a problem for the Fed unless they go above $90 or $100 a barrel. Unless oil goes to triple digits, I don't expect it to be a problem for inflation. Somebody new replies asks, if you take questions today, mine would be, when do you think Tesla will split, and what would that be? Um, I don't think splits are very irrelevant to our discussion here. Tomorrow's CPI inflation expectations year over year are around 2.9%. Median forecast is 2.9%. Previous month is 2.7%. And also, so that's an increase month over month on the year over year inflation, which is interesting. And we saw the same thing on PPI as well today. So if you look at the macro analyst account, you'll see that I reposted a screenshot from Bloomberg. PPI year over year increased from 3.0 in November to 3.3% in December, and core PPI increased from 3.4 to 3.5. So that is not a pretty picture as far as the Fed is concerned. Currently, the markets are expecting a flat federal funds rate at the end of the month. In 15 days, the Fed will announce its decision. The probability of a 25 base point cut is only 2.7%. I'm surprised it's not lower after today. But and then the probability of a cut in the next meeting, in the following meeting, is 22%. And that probability reaches 50%, exceeds 50% by June. So the markets are still expecting one cut by June, and um, and potentially a second cut by the end of the year. Let's see if there's any other insights that we can gain from this report. Musk, Zuckerberg, Bezos will attend Trump's inauguration. All right. Trump administration this morning came out with trying to talk down the concerns around tariffs. I think they said something to the tune of, we're going to have a kind of measured approach to tariffs. So over time, we're going to increase them, type of thing. But so Trump watches markets very closely. So I'm guessing that maybe they think the long end of the curve is rising because of tariff concerns. But but I don't think that's the case, and the market didn't react to that. I think there's some structural reasons why the long end of the curve is rising, and despite the PPI data that came in today and Trump comments, the long end recovered to record highs. So that's going to be a concern for um, home builders or capital goods producers. One thing I do want to look at into today is KB Homes announced earnings, and their stock popped 10% or so Wow, it actually pulled back all the way into plus 3% after a massive pump. That's amazing. That's really incredible. I mean, the stock looked like it was going to the moon, and now it's back. It's giving up like 80% of the return. Yeah, home builders are an interesting space, a space that I've been interested in for a while, and they're also really interesting today. Low PE ratios, clean balance sheets, not much debt. They buy back their stock. You would think that they are, um, good long term, and they've come down substantially in the last, month or two after I shorted them. They came down about 20, 30, 40, 50%, depending on the stock. And despite some good results that KB Homes announced, look at this roll down in this today after a pop. Nvidia stock is down 1.3%. It was up about 2, 3% this morning, and then came down 3, 4%. A 4% swing in Nvidia is more than $100 billion swing in their market cap, which is amazing. Same with Tesla. Tesla was up about 3, 4% and came back all the way to flat, now up at 1% since in the afternoon. I don't see why Tesla should be at more than $400 per share. So I increased my Tesla short position this morning. Happy to answer any questions if somebody has any. Kalshi, the betting website, is predicting, or I guess the traders on the betting websites collectively predicting 2.9% headline CPI tomorrow, and the core CPI to be 3.3%. So these are, I mean, pretty much, I mean, even the dispersion of the guesses, the range is from 2.7 to 2.7. There's one outlier, UBS, has a 3.3%. That's a massive outlier. Interesting. But their core CPI forecast is in line with 3.3%. And that's the guess of pretty much every single person, every single bank. There are two, four, six, eight, more than a dozen of them. So UBS must be incorporating some sort of energy price increases, but I think it's too early to incorporate those for in December. I think most of those gains came in January. So 3.3% core CPI. Spencer Hakimian, an account that I just started following, says this is 0% zero progress in a matter of months at 3.3% core CPI. Services inflation continues to be a problem. Especially the baby boomers. Baby boomers continue to travel, all the cruises and the restaurants and flights and hotels and not only that, but they also gain from high interest rates because they make quite a bit of interest income on their savings. So I wouldn't expect any sort of slowdown in baby boomer spending anytime soon. So the Fed has its work cut out for them. Meta is planning to cut 5% of the lowest performance, but that's business as usual. We talked about how PPI data led to PC projections rising. PC numbers are announced at the end of the month for December, and that's the one that the Fed cares about. So as far as the Fed is concerned, this morning's inflation data is not good. Markets seem to disagree. I guess we'll see. Does the weak PPI mean weak CPI? Weak PPI means weak CPI, not always, but often, writes Brent Donnelly of Spectra Markets. Recently, it's somewhat rare for the Labor Department to publish PPI data before CPI data in a given month, but before 2018, it was the norm. Looking back at 10 years of history, when headline and core PPI both fall short of expectations, as they did this morning's release of December data, CPI for the same month has come in hot only 21% of the time. In such cases, it meets expectations 39% of the time, and it too is softer than expected 39% of the time, Donnelly finds. That suggests that Wednesday, December CPI is now less likely to come in higher than Wall Street expectations. Economists have been forecasting a 0.3% rise in consumer prices. Interesting. If anybody has any questions, please request to speak. If you want to share your take on FSD 13, you're welcome to come up as well. Redfin says, part of the inflation concern obviously is shelter prices. I think the housing market is weakening, but very gradually. Um, 34% of US homeowners said they'll never sell their home. I mean, I guess that's the other reason why baby boomers are feeling pretty good despite higher rates is because they have the most equity in their homes. A lot of them don't have any mortgage left to pay. So most of them don't have any mortgage left to pay on their homes. So they're not the as the population ages, the um, the rate at which higher rates permeate throughout the economy slows down, obviously. So that's really interesting. So it doesn't matter if the rates are 4%, 5%, 6%. Baby boomers love to travel. They love to spend their money. Um, this could be, in a way, somewhat good for Tesla in the sense that the median age of a Tesla owner is kind of in the 50s. So to the extent that anybody was thinking millennials are buying Teslas in droves, that's just not true. Data shows the median age, average income levels are still very high. I actually posted a bunch of data here. I'll pin at the top here. The average household income of a new Tesla owner in 2024 is 150,000, down only slightly from 153,000 in 2018. So despite all the price tag in 2018, there was no Model Y, and there was really no Model 3. The Model 3s were 55, $60,000 for the first year. And despite these massive price cuts across the board, across the world, um, this is American households. Average American household income of a new Tesla owner in 2024 is 150,000. So it's still a rich. It's data shows it's still rich people's car. Breaking that down, new Model X owners have an average income of $162,000 in 2024, a huge jump from 146,600 in 2018. And the new Model S owners have an average income of 154,000. Model Y owners have an average of 153,000 per year. And this also explains, by the way, why EV tax credits haven't been, because most of these people don't qualify for them anyway. And the age group is also at the top of our screens. Data shows that the median age of a new Tesla owner is 48. 48. That's wild. Um, Model S owners are the oldest at 55, and Model 3 at 49, Model Y at 47. So introduction of Model Y explains the income increase, average household income increase in Model X, I think, because those make those a bit more price conscious of choosing Model Y over Model X. Um, all right. OpenAI appoints BlackRock executive to the board. Okay. I opened a short position in Spotify. I think the company's overvalued by about 50% to 100%. So my target price is half of where the stock is today. Um, it's $100 billion company, PE ratio of 134. It's gone up substantially in the last 2 years, up about 6x in the last 2 years without a corresponding improvement in the fundamentals of the company. So I think it's a good short candidate. There's also some competition from Apple Music and others as well. So it's a small position so far, but I'm looking deeper into it. Eli Lilly is down 7%, but I think it's very much a company specific type of situation. Um, Nvidia is looking really weak. Um, People say it's because of the restrictions that the Biden administration put on, but or the information article that the new product is having some issues, electrical fire issues or heating up. And but I don't think so. I think it's just the company is just extremely overvalued. Small caps are doing really well. Um, Not entirely sure what that's about today, other than maybe they're too cheap. Small caps are going to get hit hard if these interest rates stay high, as high as they've been, because they have to roll over lots of debt. Small business optimism has surged since the election and is now at its highest level since October 2018. The net percentage of owners expecting the economy to improve rose to 52%, the highest since 1983. So, at a minimum, this could be a good for hiring trends. But let's see if we can gain some insight into um, small businesses, maybe some one level deeper data. Give me one sec. Main Street uncertainty declines further as owners feel more confident following November's election results. The NFIB Small Business Optimism Index rose 3.4% points in December to 105.1, the second consecutive month above the 51-year average of 98 and the highest reading since October 2018. Interesting. That's very interesting. So small business optimism is the highest since October 2018. Of the 10 optimism index components, 7 increased, 2 decreased, and 1 was unchanged. The uncertainty index declined 12 points in December to 86. Optimism on Main Street continues to grow with the improved economic outlook following the election, said NFIB Chief Economist Bill Dunkelberg. Small business owners feel more certain and hopeful about the economic agenda of the new administration. Expectations for economic growth, lower inflation, and positive business conditions have increased in anticipation of pro business policies and legislation in the new year. Key findings include the net percent of owners expecting the economy to improve rose 16 points from November to a net 52%, seasonally adjusted, the highest since the fourth quarter of 1983. That's incredible. That's amazing. The net percent of owners expecting the economy to improve rose to the highest level since Q4 1983. What in the world? The percent of small business owners believing it is a good time to expand their business rose 6 points to 20%. This is the highest reading since February 2020. The net percent of owners expecting higher real sales volumes rose 8 points to a net 22%, the highest reading since January 2020. So I guess this would explain why. So let's see what time this data came out. 6 a.m. This would explain the the outperformance of Russell 2000 today. A net 6% of owners plan inventory investment in the coming months, up 5 points, and the highest reading since December 2021. Seasonally adjusted, a net 29% reported rising compensation, down 3 points from November, the lowest reading since March 2021. A net 1% of owners reported paying a higher rate on their most recent loan, down 4 points from November, and the lowest reading since September 2021. Lowest reading since the September 2021. How does that work? A net 1% of owners reported paying a higher rate on their. Interest rates have been going up, so I'll have to think more about that one. 20% of owners reported that inflation was their single most important problem in operating their business, higher input and labor costs, unchanged from November, and leading labor quality as the top issue by 1 point. So this would indicate, inflation pressures persist for small businesses. So the only one that kind of makes me scratch my head here. Optimism is fine. This is a survey. It's optimism is just a sentiment kind of thing. So I wouldn't hang my hat on that too much. It is notable that this is the highest in the last 50 years or 40 plus years. But a net 1% is reported paying a higher rate on their most recent loan. That doesn't make. I would expect that to be higher, but that's good to you. As reported in NFIB's monthly jobs report, a seasonally adjusted 35% of all small business owners reported job openings they could not fill in December, down 1 point from November. Of the 55% of owners hiring or trying to hire in December, 89% reported few or no qualified applicants for the positions they were trying to fill. Okay, so they can't fill their positions. Um, Labor quality, that speaks to. 56% of owners reported capital outlays in the last 6 months, up 2 points from November. Of those making expenditures, 37% reported spending on new equipment, 24% acquired vehicles, and 16% improved or expanded facilities. Okay. I'm going to skim through the rest of it, see if there's anything interesting here. Price hikes were the most frequent in finance, retail, construction, and transportation sectors. Seasonally adjusted, a net 28% planned price hikes in December. Nothing else that sticks out here to me. Okay. Let me see if I missed anything. Small business optimism surging to a now 6-year high. Importantly, hiring plans in December were the strongest since October 2022. Okay. So this is the election bump. That's a little delayed versus the last time. Last time, I think the data showed up in November survey. This is the December survey. But we're seeing a similar jump. Okay. 2016 like jump in small business optimism, reports Leo Nelson. Uncertainty next post, big drop upon clarity of policy path. Okay, let's switch to, I pinned at the top of our screens. This is the primary reason why I increased my Tesla short position this morning. I think Tesla, relative to other Max 7 companies, is 10 times overvalued. Price to free cash flow specifically is kind of sounding the alarm here. I don't expect Tesla's free cash flow to increase materially in the near future to normalize this ratio. But every other maximum company is between 30 and 50. Nvidia is 50 times. So to the extent that Nvidia is overvalued, I think Tesla is overvalued 8 times more. JP Morgan is going to announce earnings on Wednesday, tomorrow. I think that's going to be a market moving event, or it could be. Let's see. So tomorrow is going to be a pretty busy day with CPI and JP Morgan earnings. Interesting for JP Morgan, there is somebody who was supposed to succeed Diamond, Jamie Dimon, uh, just left. So there's some company specific news there as well. Quantum computing stocks rebound after massive sell-off. Some volatility there. I haven't shorted any of them. Um, it's not really an industry I know very well. IonQ is one of the top ones, up 6% today, but it's down about 40% after surging for several months. Meta to cut roughly 5% of staff, targeting lowest performance. Meta Platforms is cutting roughly 5% of its staff through performance-based terminations and plans to hire new people to fill their roles this year, according to internal memo sent to employees. Meta employs about 72,000 people. So that's about 3,600 jobs. ChatGPT will soon be able to remind you to walk the dog, according to Bloomberg article. OpenAI plans to roll out an early version of a new ChatGPT feature that lets users schedule simple tasks to be completed later as the startup works to turn its popular chatbot into a more dynamic digital assistant that competes with the likes of Amazon's Alexa. The feature announced on Tuesday will let users ask ChatGPT to draft a kid-friendly joke around bedtime at 8 p.m. or simply share a reminder to walk the dog every morning at 8 a.m. The chatbot will then send a written notification, such as an alert from ChatGPT mobile app at the appointed time. 2 years after OpenAI released ChatGPT, the product now has more than 300 million weekly active users who turn to it for writing emails, spitting out song lyrics, and searching the web. With the scheduling option, OpenAI is vying to make ChatGPT more useful throughout the day by adding functionality similar to what has been long offered by digital assistants like Google Assistant, Apple Siri, and Alexa. OpenAI expects to release the feature in beta in the coming days to its paid ChatGPT Plus team and pro users, the company said. Users will be able to schedule tasks on the web or via OpenAI ChatGPT apps and can later modify those tasks in the same chat in which they were set up. Okay. Must be a slow news day on ChatGPT front. All right, I want to look at this KB Homes um, report and see if we can gain anything out of that. I mean, that's hell of a change in the KB Home stock today after jumping double digits, coming all the way back down, despite um, really bad performance in the last couple of months across the home building industry stocks. For the first quarter ended November 2024. Okay, so this November 2024, meaning this recent surge in mortgage rates is not in the numbers. Revenue of 2 billion, up 20% over the same period last year. EPS came in at 2.52 compared to 1.85 in the year ago quarter. So some increase in EPS as well. The reported revenue represents a surprise of 0.39% over the Zacks consensus estimate, etc. While investors close to watch year-over-year changes in headline numbers, revenue, earnings, and how they compare to Wall Street, blah, blah, blah. Backlog 4,434 versus analyst average estimate of 4,370. So slightly better backlog. Average selling price is lower than estimated. Net orders slightly better. Unit deliveries are slightly better. So interesting. So ASP is lower than expected, about 2% lower than expected, but there is an increase in units. So some discounting, moving units, I guess. Grant?
Was just dropping by to see how things are going. I wasn't sure what business you were just talking about, but glad to see that the shorts are doing well.
All right. Do you have a question?
If you can fill me in on the topic that we're on, I could ask a question.
No, it's okay. Let's see. H&E Equipment Services just went up. Just the stock just doubled. Interesting. Let's look at Eli Lilly. Eli Lilly cuts Q4 forecast amid weak sales, but sees bright 2025 with $61 billion revenue potential. Lower than expected obesity shock demand. Okay. Moderna stock was low quite a bit too. I mean, this is the time that healthcare stocks should be doing all right with baby boomers, aging population, people trying to look for alternatives other than these growth stocks with higher rates and everything. But um, Eli Lilly in the last 6 months down 22%. In the last 3 months, Eli Lilly down 20%, J&J down 11, Pfizer down 10, Amgen down 20, Merck down 10%. Amazing. Healthcare plan companies are also down 10, 20%. Hmm. Maybe I should look into that a little bit. Biotech sector is down in the last month 10%. So healthcare and biotech has been hurt pretty badly in recent weeks here. The only thing that's really up in recent weeks is in recent months, I guess, or last month or so. Um, oil, oil companies. That's it, and natural gas. That's very interesting. Bank of America is warning that there won't be any rate cuts this year. Market is pricing in one by June, one by another one by the end of the year. Both US headline and core PPI inflation for December just came in below the consensus forecast, leading to some relief in yields, albeit timid as markets wait for tomorrow's CPI data, says Mohammed Al-Arian. 45% of global chief executives in conference boards report cited intensified trade wars as a leading geopolitical conflict risk for 2025, double last year's tally of 19%. German chancellor says agreement on Gaza conflict appears to be within reach. Sawyer's tweeted news Tesla improves Model Y repairability with new trunk design by separating the rear trunk lid into two distinct pieces, departure from previous single piece design. Interesting. Pretty slow news day today. I don't really see anything new here. Um, Porsche reported 3% decline in global sales. Let's look at Tesla FSD tracker. 97% drives with no critical disengagement. V13 has 8,500 miles. and it's still only on hardware 4 vehicles. Miles to critical disengagement is about 449. If we exclude the latest version, which only has a couple of cars on it, we're down to 358 miles. City miles critical disengagement is 176. So in line with my couple hundred miles per critical disengagement kind of rule of thumb here for V13. And this is before they send it out to hardware 3 cars if they ever do that. So most of the improvement is coming, it seems, from on the hardware side, which is interesting. I had said a few months ago that I think we're gonna get tens of thousands of miles of data entered by March and end up mid-January and still with about 8,000 miles. So the rollout is progressing pretty much exactly as I predicted several months ago. All right. No, not much news today. Just on macrofront, PPI came in lower than expected month over month, but year over year ticked up and is actually at the highest level since 2011. PPI final demand and PPI final demand less foods and energy trade services are highest. If you exclude the COVID bumps, obviously 2021, 2022, if you exclude those, it's as high as 2011 right now, higher than 2018 figures. So that's the problem for the Fed. All right, let's leave it there. Let me see if there's any questions on YouTube. All right, we're going to leave it there today. Thank you very much, everybody. And I'll chat with you all next time. Take care.